Joe Edelman with Osmosi here. In this video, we're going to cover another example of how you can use our data to inform your short-term investments in the pharmaceutical and biotech market. In this example, our short-term involves a portfolio selection and weighting strategy for 2-week subperiods, though this approach could also be applied more or less frequently, anywhere from around 1 to 6 weeks. This video is primarily for quantitative investors or those with short-term hold targets and is based around the catalyst event of clinical trial starts. As shown in our previous video, our predictive accuracy for individually optimized trades under this model is quite strong despite a large amount of noise in this marketplace. However, as you'll see in this video, our predictions are also very beneficial when applied in a rules-based portfolio approach with fixed hold periods. When you're backtesting our data, we will provide you with the Python code necessary to extract exactly what you need from our collection of 100+ data elements. In this example, we pull data that describes each clinical trial start and our associated prediction statistics. In each case, we provide a prediction of whether the company sponsoring that trial will outperform or underperform the broader pharmaceutical and biotech market in the 28 business days following announcement of that trial start. Clinical trial start activity can create significant buzz in the markets, but can also at times go largely overlooked. Our model uses a variety of qualitative and quantitative factors to help try to explain and predict which trial starts will result in the most outsized gains or fall behind the pack. With each prediction, we also provide our estimate of confidence level stemming from the model. One additional note to make on the dates used is that while you can see we list the official study start date as published by the company, the date that we key off of in making predictions is actually the LUP, or last update posted date. This is because some companies will post the data concerning a trial start either before or after that trial is officially slated to begin. Therefore, the earliest actionable date for you as an investor, as well as the date which drives our modeling, is this knowledge date. For context, we typically receive about a half dozen new trial announcements per day. In this exercise, we apply our strategy as follows. At each sub-period of the analysis, occurring every 2 weeks, we first look back at the prior 2 weeks and collect all of the trial start predictions that came in over that time. We roll these up by company and compute a sort of buy ratio score by multiplying the outperform predictions for that company by their average confidence level and subtracting the underperform predictions weighted by their own average confidence level. We can then sort the companies with new information over this period by this computed score and use it to determine both a minimum cutoff score for investment, in this case 0.5, as well as a relative weighting for the companies remaining in our portfolio. As an additional control, we can also compute what a simple market cap-based weighting would be for the full list of companies with news, to further isolate the impact of our predictions from any general news effects. In either case, we will hold the companies listed in the resulting proportions for the next 2 weeks and repeat our exercise at that point. We do this for the period of 2 years from August 2019 to August 2021. In the end, we can compute and combine our portfolio returns under each scenario and compare to a broad market index. Here is the growth of $100 over this time period in each of the 3 scenarios. The blue line represents our prediction-weighted strategy, while the orange line represents a market cap-based weighting of all companies with trial start announcements in each subperiod. The green line is based on market cap-weighted returns of the full universe of pharm and biotech companies in our database over the same time periods. As you can see, our strategy generates just over 2x over this time frame, which significantly outperforms both the control and the market index. There are distinct periods such as late 2019 and early 2021 where the strategy really leaps out front, but the advantage is sustained even in more volatile periods. To mitigate endpoint sensitivity, this graph shows the rolling 2-week returns of each scenario. Our prediction-based strategy outperforms in 60% of 2-week periods over this time period. While this simple framework can no doubt be built upon further, and there are certainly other ways to illustrate the benefits of these predictions in our data, we'd love to hear your feedback on this and other analyses. Be sure to check out our other videos in this series, including longer-term views based on our estimates of clinical trial value impact, which can assist your fundamental strategies. Thank you.